Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of The Real Investment Show as we get another day of going nowhere. So, yesterday, of course, markets had looked to open up a little bit, wound up, kind of trading back and forth today, finished up ending lower on really just no progress on the debt ceiling. Had a conversation yesterday. There were some, kind of some expectations and hopes that maybe things would get to progress a little bit. Nothing really happened to any great degree. President Biden cutting his trip short, coming back to the U.S. now to negotiate further on the debt ceiling deal as that deadline approaches. Of course, has everybody, kind of anxious right now. But as we talked about, this market just literally is dead. It just goes nowhere right now, just kind of trades back and forth in range. This morning, futures are pointing up here a little bit. Target announced better than expected earnings, came in really kind of across the board, a good beat on both revenues as well as earnings. Now, of course, that earnings had been brought down. Those estimates have been brought down a bit, but came in at 205 versus the $1.76 estimate. So again, that's a pretty big beat, even over the estimate right now. Stock's going to trade up this morning, about a point or so on that news. And but here's important is that we saw yesterday the retail sales number and the retail sales core number, which is kind of the core good sales that a lot of economists look at, continues to trend in a positive direction. So, all these concerns about a big consumer slowdown, et cetera, hasn't really, matured yet. Doesn't mean it won't, but so far consumers seem to be kind of hanging in there. Now, Target is, of course, a very different company than what we saw yesterday with Home Depot, and was exchanging some tweets this morning on that very issue, because yesterday Home Depot announced a pretty dismal result and really kind of some of the worst earnings they've had in like 20 years. So it was a very bad report for Home Depot. Target coming out, very different story. Now, why the difference between the two? Well, remember that during 2020, 2021, as we were sending $5 trillion worth of checks to households and everybody was locked up in their house, what'd they do with the money? They went to Home Depot. Remember, we used to joke about this in 2020 is that, we're supposed to be all locked down in our house, yet you go to Home Depot and they were packed with people buying stuff, lawnmowers and washers and dryers and everything else to, build decks on their house and put in a pool and all this other stuff. So we were spending all this money at Home Depot and Lowe's, of course, during that period to, add a home office, right, or whatever we were doing to our house. It was a lot of fixer-uppers during that 2-year period. So we pulled forward a lot of Home Depot sales in 2020, 2021. So what you're getting now is that boomerang effect for Home Depot that's coming back around. Now, Target's a little bit different animal because that's stuff that people need to buy all the time, right? I mean, kids are still needing diapers and, you still got to get food. You got to, buy the stuff to just live your daily life, right? Toilet paper and all those type of things. So, the consumers on those sides, that's spending that is going to have to continue at some point. Now, retail consumers may be pulling back some of their more, luxurious expenses, right? Those kind of the things I want maybe get put off a little bit, but things you need are still going to get bought because you have to still live your life. And that's just something. So the thing to be paying attention to over the next really kind of few days, we're getting a lot of retail sales reports out, but pay attention to these stores that are more on the lower end, the Dollar Trees, the Dollar Generals, the Targets, the Walmarts. Pay attention to what they say. Not just on earnings, but also are they reaffirming their guidance for the year, or are they getting more negative? Now, Target reaffirmed their guidance this year saying, hey, the outlook is okay. We don't see any kind of big headwinds right now. And again, this is a little bit kind of juxtaposed to what everybody's been expecting, was this big crash in the consumer. And yet they seem to be kind of holding in here right now. Now, the one caveat to that, of course, is tighter credit standards. Tighter credit standards obviously is going to crimp disposable incomes, of course, for the average American, right? Because they have their wages coming in. Wage growth is definitely slowing now. We've seen that data here as of late, which means they're going to have to turn more and more to credit cards to continue to support their living standards. And with tighter credit, of course, that's going to lower that ability to obtain more credit to keep consuming at the same pace. So there's certainly some risk to these retail sales numbers as we go forward. But right now, at least, these numbers are doing okay. And this is why we're looking at GDP for the second quarter around 2.5% growth in the second quarter. Now, that's going to be better than the 1.1% growth we saw in the first quarter. But importantly here, there's no real sign of recession right now. And this is going to be one of the things that we've really got to pay attention to. Lots of really negative headlines around the globe right now about recession and this and that and the other thing. But yet the data continues to support this idea of at least steady growth, even slower, but slower growth, but still steady growth within the economy. We haven't seen that big backlash yet that everybody's been expecting. Doesn't mean it won't come, right? We need to keep paying attention to that. We need to pay attention to the data, but that turn has not entirely showed itself just yet. So again, keep paying attention to this retail sales, because retail sales are important overall because they make up 40%, as we said yesterday. Retail sales make up 40% of PCE, which is 70% of GDP. So if we're going to see a crack in the economy, it's going to show up in retail sales. That's where you want to kind of be looking. That's going to be your boots on the ground kind of indicator for a real turn down in the economy. And we just haven't seen that just yet. Okay, having said that, again, last few days, market continues to go absolutely nowhere. Today looks like to be another day. Dow looks up to be about 140 points this morning. The S&P's up about 16. Something, kind of the same thing we saw yesterday. Again, sustainability of these rallies has been really just very, very difficult to come by. And, this has been kind of challenging for investors because, again, kind of no matter what you do right now, you're just kind of stuck. And in today's daily market commentary, which is on our website now, we compared, yesterday's market performance to that over the last 3 months in terms of just what stocks are leading the way. And not surprisingly, it's a very narrow handful of stocks, just those big cap names: Apple, Amazon, Microsoft, Google, Nvidia. Those are about the only stocks that are really dragging this market higher. Something we've talked about before, and that remains the case right now. That is not sustainable long term. Once we start looking at other sectors of the markets, there's a lot of sectors of the markets really out of favor right now. And at some point, you're going to get a rotation out of technology into some of these other areas. Now, it doesn't mean tomorrow, doesn't mean next week, next month. But again, it's just, the deviation between what's happening in technology versus the rest of the market is not sustainable long term. You can't have just, a market breadth of being that narrow is not sustainable long term. So you're going to get a rotation. Doesn't mean the market has to fall apart. Doesn't mean you have to have a major correction, but you are going to get a rotation in this market. So don't forget to take some profits out of your technology stocks. If you've got a lot of tech in your portfolio right now, take some profits. There'll be plenty of opportunity to buy it back cheaper a little bit later. Okay, this morning got a lot of stuff to get into with Danny Ratliff. He'll be joining us right after the break. Be sure to get by the website. Michael Leibowitz's new article is on the website talking about bonds and why the expectation is still that bonds are going to be a decent outperformer as we get past all this debt ceiling issue and debate. That's on the website now, realinvestmentadvice.com. Stick around. Danny Ratliff will join me right after the break. We've got to get into quite a few topics this morning: IRAs versus Roths, and more importantly, what do Americans do after debt ceiling crises? We'll talk about that next, right here on The Real Investment Show.
News you can use. Delivered at the speed of the internet at realinvestmentadvice.com.
Why, Red, whatever are we gonna do over this hot, lazy summer?
Don't you worry, little darling. We gonna break our money malaise. Don't let the summer doldrums sap your money's worth. Register for our next Candid Coffee with Danny Ratliff and Richard Rosso with summertime tips for your idle cash. Saturday, June 3rd. It's our half-year financial checkup, breaking your money malaise this summer. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. RealInvestmentAdvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Of course, I'm your host, Lance Roberts. Danny Ratliff joining me as well. Good morning, Danny. How are you?
Good morning. Doing great. How about
Good.
you?
So, question is, of course, the big profile headline right now is the debt ceiling debate. Of course, one side of the coin is that, oh my gosh, the world's about to end. And the other side of the coin is we've been here before and done this, and it's no big deal. In fact, we've done it 79 times or 78 times, about to be 79. And we'll get through this, but it's kind of interesting because, again, I was just reading an article this morning from Bloomberg saying if we don't get the debt ceiling done and the Treasury has to cut spending, that'll be an 8% hit to the economy. That's massive, by the way. That's like depressionary type statistics when you start talking about an 8% decline to an economy. But this is some of that hyperbole that's out there, right? So, again, the question is, of course, that, when we take these things to extremes, obviously, right, which is we don't raise the debt ceiling so we can issue no more debt. Okay. Now, if we can't issue debt, that means that we can't fund the difference between what we have agreed to spend in the budget versus what we can pay for, right? So that debt is the credit card, so to speak, for the household, right? You have, Danny has got $100,000 coming into his household. He's a really rich guy. So he's got $100,000 coming in, and his wife has promised to spend $150 this year. So Danny's got to make up the difference between the 50 and 100. So he's got to go get credit card debt. Same thing for the government. That's all we're talking about. So one aspect of this, kind of from a logic standpoint, says, okay, well, if we can't issue more debt, then yeah, we're going to have to cut spending, right? Now, that is bad economically, considering the fact that government spending makes up a chunk of the GDP. When we take a look at the GDP report, right, we get that out, once a quarter. Right now, Atlanta Fed is predicting 2.6% GDP growth for the second quarter. 70% of that number is what you and I and Danny spend. Mostly Danny, but what you and I spend, right? That's the personal consumption expenditures. That's what we're spending. Part of this is net imports and exports, right? The difference between what we export and import. Part of this is private investment from businesses. And then a chunk of it, of that remaining, of the remaining 30%, a piece of that is government spending. So yeah, if you strip out government spending entirely and say there is no government spending, you're going to have a drag on GDP growth. But see, that's not even really the case. Yes, government won't be able to spend at the rate that they're spending, but they still have $3.5 trillion worth of tax revenue coming in to spend. You just can't spend $5 trillion on things like infrastructure rebuilding and all this other stuff that you want to do. Those are going to have to be put on the shelf for a while. So that would create an economic drag, absolutely, if we can, and this is assuming that we never resolve the debt ceiling, right? This is where we take things to extremes. If we never raise the debt ceiling, that means we're going to have to permanently shutter parks. And those 950,000 non-essential workers that we have to lay off from the government will have to be laid off, period. That's what's going to happen. 1995 bill guarantees that Social Security will always be paid. So out of that $3.5 trillion, interest on the debt will get paid, Social Security will get paid, medical and federal will get paid. So it's important to keep these things in perspective. The reality is that, yes, we're going to get the debt ceiling passed at some point. Somebody's going to cave. This is all we're doing is playing chicken in Washington. Right now, it's Democrats versus Republicans, and it's just whoever blinks first. That's all we're talking about. Will Republicans cave in and back off wanting any type of spending cuts or spending reforms or budgetary responsibility? Probably. They've done it every time in the past. Will Democrats back off wanting to spend more money? Absolutely not. So somebody's going to blink. We'll see who it is, but we'll get there. So the question, though, is what happens and what do Americans, this is an article on The Economist, what America does after a debt ceiling disaster. Sounds like a pretty grim headline, Danny.
It sounds terrible.
So how many times have we had a debt ceiling disaster in history? Do you know?
A true debt ceiling disaster?
True debt ceiling disaster.
I mean, never.
Then how do they know what Americans do after the fact?
Yeah.
That's my only question. I mean, the closest that you can get to a debt ceiling disaster was 2011 when we went through the whole debt ceiling debate issue back then. So I guess that's their point of reference, right?
Well, which we've been through many other times, but I mean, we had it delayed. It wasn't necessarily a complete disaster. Now, the market didn't like it initially, but as things kind of worked their way through, things got better.
Yeah.
Now, certainly a much different economic environment than where we are today. I mean, we can make an argument that, you look at PE ratios from a stock perspective, much different than where we are. However, we have to deal with we have to play with the cards we're dealt. So I think the interesting thing here is that we're seeing all of this, like you said, this information that is just dire, right? It's designed to get clicks. And what happens? I mean, what truly happens if we get in this environment? And you talked about Republicans versus Democrats. And let's be honest, if Republicans were in office, Democrats would be doing the exact same thing that they're doing. They're both going to spend money. They can't figure it out. Many other problems that you and I won't solve today in this next 20, 30 minutes. But inevitably, this will get done. It's just a matter of when and what that timing looks. We know they're going to take it down to the wire. More conversations today. The interesting thing is they cut President Biden's travel plans short.
Right.
But he's not even meeting. And McCarthy's not even meeting. It's two of his aides and one of his aides.
Right.
When you start to actually see what's going on, it's like, wait a second, this doesn't even...
It doesn't even rise to the level of desperation that we can get President Biden and McCarthy in the same room, right? Yeah. Just let the aides do it. We'll be good.
And I'm just wondering, like, how old are these aides? I mean, are these guys that are just out of college that are interns?
They're
in
their
20s. Oh man, the state of affairs.
But let me read to you this first piece. Now, this was on Yahoo Finance this morning. America is once again in the throes of a debt ceiling crisis. If Congress and the White House do not come to a deal, the government may run out of cash and be on the brink of a sovereign default, thereby in just a few weeks. Most investors expect a last-minute compromise, thereby avoiding financial Armageddon, as during past crises. Yet positions on each side remain entrenched. So, I mean, this is the kind of hyperbole that's out there, right? Financial Armageddon, sovereign default. Again, we're not going to default on our debt. At some point, you're going to pay. The debt will always get paid. We may have to delay an interest payment if we actually get so far past the X date, even we can't raise money coming out of the discretionary spending budget. But, again, this is something we have actually been in before. 1979, we had a technical default, missed a payment because of the debt ceiling crisis. So been here, done this many times. It always gets resolved. And again, to Danny's point, a lot of this is just to get headlines and, it's clickbait more than anything else. But, the problem with this is that it gets investors doing the wrong things with their money. I'm getting lots of emails about this, and it's like, oh my gosh, I just need to have, if my money's in money markets, what happens if we default on our debt, right? And we're not. Just relax. It's fine.
But that's a good question, right?
Yeah.
What happens?
Well, money markets are basically short-term bills.
Correct.
Right? So let's assume the worst. We get no debt ceiling done. We missed interest payments, right? So that means that the interest payment coming in on the 3-month T-bills doesn't come in. So how's the money market supposed to pay you the interest payment?
Correct.
Right? So the money market fund would have to say, hey, we can't pay you any interest on this until we get our payments coming in.
Which, once they remediate this problem,
Right.
they're going to come back and make back payments.
Correct. It all gets caught up.
Yeah.
So, yeah, I mean, there's certainly ramifications, but the reality is, like I said, at the end, we go back to the beginning of all of this. There is the mandatory budget, which requires it to be paid. So out of the $3.6 trillion of money that comes in, it goes to pay interest on the debt, Social Security, Medicare, Medicaid, and prescription drug benefits. That all gets paid first. Out of that, whatever's left over, that goes into discretionary spending. Now, one of the issues that we also have the ability to do, nobody wants to do this right now because nobody's back is against the wall. You can also prioritize payments.
Correct.
And so you have money coming in. Every month, the government has money coming in. We have money coming in on April 15th from taxes. We'll have money coming in again on taxes on October the 15th when delayed filers pay. So there's always money coming into the government every single month. Sales tax revenue, all this type of stuff. Constantly money coming in. So when that money comes in, the government will have to prioritize payments. Oh, well, I can't fund windmill building. I've got to go pay interest on the debt. Surprise is that just like a household, there are things that we want to spend money on. Doesn't necessarily mean we can spend money on those things right now. We have other bills that we have to pay first that are more important. And those are the mandatory spending requirements of the budget. So again, this just, it's important to keep all these things in perspective. We've been here before. Yes, if we get into a real debt ceiling showdown like we did in 2011, where there was an actual standoff, we went past the X date, and surprise, surprise, everything was still getting paid. We had to shut down the government. We had to lay off non-essential workers and close parks. Everybody's very upset about that. I get it. Smithsonian was closed. But we got through that. We came up with a bipartisan commission. That's where we had put in that we're going to cut $1 trillion worth of spending, and we had the whole fiscal cliff issue coming up in 2012, and it was all a disaster. Stocks were down about 20% that summer during the debt ceiling debate. They recovered all of it by the end of the year.
Lance, since 1976, there have been 22 times that the federal government had a shutdown due to lack of a federal budget.
So amazing. And how many of those were in the last decade?
It was Armageddon.
Right. How many of those government shutdowns happened in the last decade? Because there's a bunch of them.
Yeah, no, there have been. I mean, you look at 2011, 2013, we had a pretty significant shutdown. I mean,
yeah.
There is a lot of this that is not just, it's in the rearview mirror. We've been there, done that. But we do have to be cautious. I understand people's concerns. Certainly warranted.
Yep.
But I think the likelihood that this plays out well, yeah.
Yeah, just to keep it in perspective. Don't make bad emotional decisions based on clickbait headlines. That's our only comment here. All right, quick break. We'll be right back with Danny Ratliff. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Wow, Red, whatever are we gonna do over this hot, lazy summer?
Don't you worry, little darling. We gonna break our money malaise. Don't let the summer doldrums sap your money's worth. Register for our next Candid Coffee with Danny Ratliff and Richard Rosso with summertime tips for your idle cash. Saturday, June 3rd. It's our half-year financial checkup, breaking your money malaise this summer. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Part of the problem of the average American is that we've just chosen to live well beyond our means.
Basically, you can buy anything you want out there on a payment. You need new underwear? Go get it on a payment plan.
Underwear can be expensive. If you buy some Jimmy John's, they're not cheap.
Jimmy John's.
And
Sandwich
the point
underwear?
is,
What is this?
But Tommy John's, thank you.
The Real Investment Show podcast.
That's why I just don't wear underwear. It's too expensive anymore.
At realinvestmentadvice.com.
Going commando is going to become a new thing for the poor people.
It's going to be a...
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, Candid Coffee, and Lunch and Learn replays, plus each day's radio show. Subscribe and bookmark our YouTube channel or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Hey, good morning. Welcome to the show. I'm your host, Lance Roberts. Of course, Danny Ratliff joining me. So, stressed about money. Obviously, kind of a big topic right now. I thought it was interesting this morning regarding this, kind of this idea about money and what's going on, et cetera. There was an interesting survey out, and this was from the Wall Street Journal. It's a poll of 1,019 adults that was conducted between March the 1st and the 13th of this year. And it was interesting. They said, what values are important to you? In 1998, they've been doing this survey for a long time, by the way. In 1998, patriotism was 70% as an important value. Today, it's 38%. Religion has gone from 62% in 1998 to 39% as being an important value. Having children has gone from 59 to 30%. Community involvement has gone from 62 to 27%, and money has gone from 31 to 43%. So the point is that it's interesting that we have now created this paradigm shift more to being, this idea about money being important and the status of our lifestyle and the things that truly make us happy over time, right? The things that provide fulfillment, the things that that provide you a positive outlook, those type of things, patriotism, religion, having children, being involved in your community, being involved in your church, those relationships, those social gatherings, et cetera, have fallen far and away from that. And it's not surprising, with social media, they have, regular polls that show loneliness as being a very big problem of the current generation coming up. They're detached from reality. They're detached from community. They're detached from other people. Being online is great, but you're still sitting alone, right? And there's a thing that happens when you're involved with other people and you're involved in your community and your church or whatever it is. It's that community, that social aspect that gives you fulfillment in life. It makes you happy, and this is why we see a lot of issues of rising depression, more drug use in terms of, I don't mean drug use like illegal drugs, but more drug use in terms of treating things like depression and anxiety and all these type of things. But the focus has now turned from these things that provide social and provide social fulfillment into money as a hopefully finding a replacement, right? If I just have more money, then I'll be happy. And this is always the problem that people get into. More money is going to make you happier. And yet what we find out is that the more money you make, the more money you need, because you keep upgrading your lifestyle to where you're at the point you're still stressed, right, about money. So I was making $20,000 a year, now I'm making $40,000 a year. Now I'm stressed because I don't have enough money to support my $40,000 a year lifestyle. So now I've got to make 60. And this is the chase that inevitably occurs. And it creates, there's always the old saying about money is the root of all, I got that backwards. They say, I hate when I screw shit up like that. So, money doesn't buy happiness, right? And that's the point that, we think we can solve with money. Of course, and this is the thing we're always trying to solve. And it was interesting because there was an article out today. This was on CNBC talking about stressed about money. The number one way to worry less, and this is from a behavioral wealth specialist, and talking about that, 70% of Americans report feeling financially stressed. And of course, they're unhappy because they're financially stressed. When you take a look at divorce statistics, the top two reasons for divorce in the country are infidelity and financial, right? And so, of course, if you're having financial stress, that means you're probably not focusing on the marriage, and the fidelity becomes a problem. So generally, those two are fairly linked, pretty close to the hip, and that, we continue to see rising levels of divorce. So, it's kind of just an interesting dichotomy that we've got ourselves into today in terms of, what we think will solve our, if I can just get more money, my problems will be solved. Yet the more money we make, the more problems we have. And some of the most unhappy people you will ever meet are rich people. They are miserable most of the time. So, it's not what we think. So it's important to try to keep these things in perspective. But Danny, this it's kind of an interesting story that, this idea of, focusing on, how to reduce financial stress.
Yeah, I think you bring a couple interesting points. Number one, going back to what you said a moment ago was, I don't know that it's rich people that are necessarily unhappy. I think the rich or let's say wealthy. Yeah, they figured it out. It's the people who are, they're living above their means. They may have a high income, and like you said, they make 20, now they need to, then they get to 40, now they need to know how to make 50, 60, 70. It's that perpetual hamster wheel. I mean, I remember when I first started off in this profession, there's a handful of ways. I worked for a big firm, and they said, okay, great, now you need to go buy a house. Oh, you need a new car. You need this. Constantly, the management would always tell you needed to go do more because they wanted you to go have to make more just to keep up with your lifestyle. And I think that's very prevalent, especially in corporate America. And so that, I think, leads to that financial stress over time, because what if you don't always make more money? I think, most people are probably more optimistic than not. And we always think we're going to make more money. We're going to get that bonus. And the issue becomes is that at some point you start living above your means to keep up with that lifestyle creep. And this is what we talk about frequently within financial planning, with how we work with clients, making sure that, okay, great, you got that raise. What are you going to do with it? How can you put yourself in a better situation? And so it's understandable. 70% of Americans say they're feeling financially stressed because of inflation. Mm-hmm. And this is a big one. When we look at financial plans, we're having a lot of clients that are actually cutting back, but yet they're still spending the same amount of money because of what it costs to go out to eat, what it costs to get groceries, filling up the tank. Well, that's come down some, not nearly as bad as what it was, but still not great. And so, I think that, living inside these vacuums, and when you see everybody, you talked about the stress that many people feel. And I think, social media has become a major problem with this, Lance, is because we see only, one, it's an echo chamber. What you're looking at is going to just feed right back into it. The algorithm is going to show you the same exact stuff. But that's not always what you see. You ever see those, I don't know if they're called memes or GIFs or whatever, where they say, okay, here's the internet and then here's reality.
Right.
People actually trying to do it. And unfortunately, that's not what is shown actually what goes on in the real world. I mean, we all have friends that you see online and you're like, how in the world do they live this lifestyle? That's not exactly what they do every day, right? They're not in Turks and Caicos every weekend.
Right. But no, look, it's a real challenge, with my kids, as an example, because, like I was talking to my daughter just the other day, and she's got big dreams and aspirations for life, right? And which is great. You should dream when you're young. You should have dreams and aspirations and goals and all those type of things. And it's a hard conversation, to get them to understand that what they see on the internet and on TikTok and on Instagram, et cetera, is not real in most cases. There's some 20-year-old kid and he's like, oh, here's my, collection of high-end exotic cars. And I've got, 15, Lamborghinis sitting in my driveway type thing. Probably not real. He's doing it for clicks and for views and those type of things. And, so it's also just not realistic to have those type of expectations. And for instance, my daughter's like, man, I really want to go live in New York. And I'm like, do you have any idea what it costs to live in? I think living in New York's got a romantic tinge to it. Everybody, you probably
especially when you're young.
In their life, it's one point of your life, you want to go live in New York. I lived in New York for 2 years. It's it costs more to park my car in New York than it did for the apartment. So, it's just crazy, right? And it's just, those are the type of things that, you've got to kind of connect the dots to. And it's like, great, if you want to go do that, you're going to have a career that will support that lifestyle. And so this is going to become the bigger challenge. And this is where we get back to, and Danny's not there yet. His kids are a lot younger, but he's not to the point of having to talk to his kids about what career choices they're going to have to make yet. But I'm in that phase right now. I've got 3 kids either in college or about to be in college. One's out. And, talking about the next generation of where jobs are going to be, right? Artificial intelligence, robotics, healthcare. These are going to be the areas that can make money. And there's certain things that are going to be consistently better paying jobs versus a lot of other degrees. For instance, if you go get a degree in management, as an example, it's a very nebulous degree, doesn't have a lot of teeth to it. And so you've got a management degree, that's great. That may get you into the door of a business, but you better have a skill set that goes along with that, of whatever that is, whatever that business needs. So a more defined degree, and this is the conversation we have, is like, instead of just getting a general management degree, which doesn't really teach you a lot, now you're going to have to need a lot of experience to prove up what you're doing. Have a defined degree, finance, accounting, artificial intelligence, computer engineering, those type of things. That not only gets you in door, but you walk in with the skill set. If you're going on the business side, right? If you're going into other areas, if you're going to be a doctor, you need to be, focus on that. But these are the conversations we're going to have with our kids, because it is a very different world that they're growing up into, and this reality of what is life and what money can do for you versus what you see on the internet are two vastly different things. And that's the biggest challenge that we as parents have to help our kids be successful in life. All right, be right back after the break. Danny Ratliff, join me, and we'll wrap the show up. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Wow, Red, whatever are we gonna do over this hot, lazy summer?
Don't you worry, little darling. We gonna break our money malaise. Don't let the summer doldrums sap your money's worth. Register for our next Candid Coffee with Danny Ratcliffe and Richard Rosso with summertime tips for your idle cash. Saturday, June 3rd. It's our half-year financial checkup, breaking your money malaise this summer. Register now at realinvestmentadvice.com. Candid Coffee with Ratcliffe and Rosso. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So getting ready to just talk a little bit about, money, financial stress, these type of things. And this is something that everybody deals with, all the time. And financial stress is not new to anybody. Everybody has it. And it really doesn't matter, like I said, how much money you make. Some of the most unhappy, miserable people I know are rich people. And, they're just not happy. They're not, they do great. They make a lot of money, but they don't have any fulfillment. So it's important, and again, this goes back to that survey from the Wall Street Journal. This whole, kind of breakdown in society that we've had really since the turn of the century has been, pretty dismal. Again, just a dramatic fall in patriotism. The number of people going to church has dissipated dramatically, right? And the idea of having children has dropped markedly because, again, people are becoming, and you hate to say this, but they're becoming more self-centered, right? I don't want the responsibility of children. I want to be able to, kind of live my life the way I want to live it and do the things I want to do.
Which all those things go hand in hand, right?
Right. Yeah, and when you have children, they take up a lot of time.
No, not a lot of time. All of your time.
But they're also very fulfilling at the end of the day. And again, when you kind of look back at your life, you say, what made me the happiest? What were the moments in life where I was most happy? I doubt you're going to say you were the most happy in your life when you were sitting around the couch watching TikTok, right? It's going to be, I was, this one time I was on vacation with my friends and we had a great time, right? And that's one of the happiest moments I had, whatever it was, the day I got married, day I had day I had children, those type of things. Those are the things that provide fulfillment in life. And unfortunately, if you don't have religion, you also don't have anything to look forward after life. So, there's also that. It doesn't lead you a lot, to work with. So, it's important that, money is important, right? And as I said earlier, money can't buy you happiness, but money buys you a lot of whatever comes in second. So I'm not discounting that money is not important, because it is. It provides us the facilities to do the things that we want to do that can make us happy. Again, it won't buy happiness, but it can provide the ability for us to do the things that make us happy. The question is you have to find what it is that actually makes you happy. And if you're not happy, you need to ask yourself, why am I not happy? Why am I not fulfilled? Why do I not look forward to getting up every day? And then start figuring out what that problem is, because it's not money. And that's the thing you have to focus on.
Yeah, and I think money, it's really important in the aspect that, it's what we deal with every single day. But it's that financial security, the freedom that allows you to do things. And, I work with a lot of different types of people and a lot of small business owners that get to a liquidity event. And the guys that are most successful, or just in retirement, are people that have a plan. Now, a lot of them, they continue to work. They're like, hey, I'm not slowing down. This isn't, I enjoy what I do. I'm going to continue to do this. But if they don't, if they say, hey, I'm going to get this paycheck and hang it up, they have a pretty defined plan as far as what they're going to do. They're not just waking up and kind of, they're not a feather in the wind, so to speak. They have a plan as far as here's what my day is going to look like. Here's where I'm going to spend my time and energy. And that may be, service work. It may be with kids. It may be with grandkids. But every one of them has some type of idea as far as what they envision. The ones that I see that don't have much planning, so to speak, that's where they get in trouble. And I think that's just anything in life.
Yeah. But again, when you talk about this, when you talk to successful, happy people, right? It's to your point. Well, okay, when you retire, what are you going to do? Well, I'm going to be involved in my community. I'm going to do service work. I'm going to work for a charity. I'm going to do, I'm going to work through the church, whatever it is. But there's always some type of involvement being there, right? They're remaining active. They're remaining involved in the community. They're remaining involved with other people.
Social networking.
Yeah. Those type, playing golf with your buddies, whatever it is. But it's that human connection, it's that human interaction that provides fulfillment and happiness. And, this is the one thing that, we're starting to drift more and more away from as we become more isolated as individuals. But this is also why we see such a rise of people being so unhappy, so depressed, these type of things. And yes, we all want to point it back to being the issue of money. And it's not fair because I don't make as much money as I should be making to make me happy. There was an interesting article out today. There's a guy who's been on sick leave for 15 years.
Okay. How do you pull this one off?
So it's in Europe. He works for IBM. No. He works for IBM, but he lives in Europe. And he's been making $67,000 a year for 15 years. He's been on sick leave. He had leukemia.
Disability.
So he's been on disability. But IBM's kept him on the payroll at $67,000 and change a year for 15 years. And he sued IBM because he was not given a raise in 15 years. Now, he lost the case in court. The judge threw it out immediately. But the guy actually sued IBM for not having gotten a raise after being on sick leave for 15 years. So,
wow.
Yeah. I can't figure that one out, but there you go.
What does his performance reports look like?
Did not show. Hey, wait, do I have that from yesterday? Let's see. Performance reports. These are actual quotes from performance evaluations. Since my last report, this employee has reached rock bottom and shows signs of starting to dig. His men would follow him anywhere, but only out of morbid curiosity. I would not allow this employee to breed. This associate is really not so much of a has-been, but more of a definitely won't be. He would be out of his depth in a parking lot puddle. This young person has delusions of adequacy. So those are actual statements on evaluation.
All on one person?
No. These are different. But
it's like, wow, this is a really creative manager here.
Yeah. But so I can't imagine performance reports every year. He did not show up to work. He's been on sick leave this year. He should go far.
Well, if he was a government employee, he probably would have gotten those bonuses.
Probably. This is a true fact. But just to wrap this up, and we'll get on to other topics here. But like I said, it's important to, and this is I think going back, we talk about raising money smart kids. We talk about doing all these type of things for your kids. How to make them financially better stewards of their money. We those are the mechanics of being financially well off. But it's also important to teach your kids how to be happy. And that's a very different and tough challenge in today's environment. So it's something you've really got to have a lot of, spend time with your kids and talking to them about, there's more to life than what you see on social media.
Well,
And
I
it's a
think
real
identifying those biggest stressors and then communicating well with it. The most successful families, I talk about this frequently, are especially monetarily, are the ones that communicate and communicate well. I have a lot of conversations with our clients and about their kids, and sometimes says, well, okay, hey, this is great, but are you going to relay this information to them or should I? Because if you're not going to talk about this, then what are we doing? And essentially, what are you doing? And that's where we start to establish bad habits. You see a lot of it where people they'll bankrupt their own retirement for their children. And I've seen this happen time and time again. And, I promise this is it. I'm not going to do it anymore. And then a phone call 6 months later. Hey, so this came up. And I get it. I'm not in those shoes as of yet, but I've got a lot of experience dealing with it. And I can tell you is that, we talked about that hamster wheel. Once the kids get on that, they drain the bank of mom and dad pretty quick.
Yeah. No, they do. And that's so anyway, enough of that. We've got there.
Yeah. I'm sure everybody's all right.
So Danny, any issues that we've got working on? I know we've talked before about Roth IRAs and these type of things. What's the latest kind of update on that?
Yeah, I think having a lot of conversations about people saying, hey, where do we put money right now? Can I put funds into the Roth IRA or traditional IRA? This is something that we do speak about frequently. You can contribute to a general IRA for the year prior, all the way up to about April 15th or tax day deadline. But now starting to think about what does it look like for this year? For somebody that's under the income limits, I would certainly go ahead and start making those contributions. If you have the ability to potentially be over it, you do need to be careful here. So, but we can always go back and recharacterize those types of contributions. Now, if you do a conversion from a traditional IRA to a Roth, you cannot. So that's one area I think the media is beginning to talk more and more about it. We do need to understand the repercussions of income limitations. And if your CPA were to come back to you and say, hey guys, you did a little too much, we may want to pull some off the table here. You cannot on that conversion. Now, one other thing, as we look at a lot of employer plans and we're seeing more and more Roth 401ks. And there's this big misconception, Lance, that if you make too much money, you can't put funds into the Roth 401k. Now, this is much different than the Roth IRA in the sense that there is no income limitations. You can put up the exact same amount in a Roth 401k as you can a traditional 401k. There are no income limitations associated with it, unlike the Roth IRA. So on a Roth IRA, for example, if you're making, you can put up to $6,500 if you're under 50. You get that $1,000 catch up if you're over. But if you're single and you make less than $138,000, you can contribute to it. If you're married filing jointly, it's $218,000. And so somebody who's maybe making $250 married filing jointly may say, hey, I can't put the funds in. You actually can. But you need to understand, what are the tax ramifications? You're not going to get the pre-tax, so your paychecks will shrink a little bit. But long term, will you actually retire in a lower tax bracket?
Probably not.
I don't know. I see it often that you actually don't.
My goal, though, is to retire in the highest possible tax bracket, right? I want to have enough money in the bank that my income generation from that puts me in the highest possible tax bracket. That's my goal.
But we'd want to be able to. I want you to have the most income and pay the least amount of taxes.
Well, I understand that.
That's the other caveat. Where do you put the funds to avoid that?
Right. Exactly. But you won't let me retire anyway, so it doesn't matter.
Yeah, you're never retiring. What does it matter?
That's why I have a strong belief in religion, because I want to get out of here.
Yeah. So Lance is on the DAD strategy, DAD, diet desk.
Exactly. Sooner the better. Anyway, have a great day. We'll see you back here tomorrow with Michael Leibowitz. We'll get caught up on the Fed, interest rates, inflation, and whatever else is going on in the markets. That'll be tomorrow's show. Of course, in the meantime, get by the website, realinvestmentadvice.com. Have a great day. See you tomorrow.